Hi everyone, it's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom series. Today's topic, capital acquisition strategy. The question is, if you have a business, an existing business, or if you're doing a startup, or if you're contemplating, thinking about starting a business, you do face the question of whether you need outside capital. And outside capital could be, a loan from the bank, a loan from family, the use of your savings, mortgaging your house, cashing in your bonds, and other ways, perhaps finding an angel investor, finding somebody that is interested in supporting your business idea. So you face this question. And so what are some considerations? I'm going to divide this talk into two categories. Category one is the bootstrap method of starting your business, and category two is the use of capital, whether debt or equity, and we'll talk about that in detail, to do a startup or an expansion. Let's quickly dispose of the first one because it's the shorter topic. The first one is the bootstrap method, and in this method you find your working capital, that is the money that you need, to lease a building, buy some equipment, hire some staff, build some product, order the product, the inputs, store the product, ship it, and finally sell it to the customer. Bootstrap method allows you to pay for all of that using either money that you generate from the business, and that seems impossible because you have to do all that first before you even get a sale. But let's just say that you have figured out a way to finance it first so that you can get that sale and then the revenue comes. Your bootstrap method then allows you to do this on your own, using your own money, and eventually you get onto a cycle where the revenues, pay for your costs, and pretty soon you catch up. If you might have been in a little negative cash flow or a negative deficit where you have your revenue doesn't actually cover your costs, or you have to pay back somebody, family member or somebody, you have to pay them back for the money they lent you or gave you or invested in you, which means that you have a partner then. So long story short, the bootstrap method is one way to acquire capital for your startup, your growth, or your expansion. We'll dispose of that topic, and now we'll move to the other one, which is the vast majority of businesses face, and that is the use of debt or equity financing to do your startup or your expansion. So let's take a look first at the concept of debt. Debt is borrowing someone else's money, paying interest on that money, using it to buy your inputs, lease the building, pay the staff, get the equipment, order the stuff, build the product, market it, advertise it, sell it, and finally collect the money for it. So you borrow money. There are several methods borrowing money. One typical method is a bank line of credit. And sometimes there are personal lines of credit that wealthy people will offer to a startup or an early stage company. But before a bank gives you a line of credit, you will have to establish some kind of credit worthiness with that bank. You're not going to get money from a bank unless you already have revenue, or you have the promise of revenue, or you have a backing wealth yourself. Maybe you put up your equity in your house, or you put up various other assets that you have in order to prove your credit worthiness to the bank. But a line of credit is a useful way. It's actually considered a good way by most people because you can draw down the line of credit as you need it. You definitely pay interest on it, but you can draw down only that amount of money that you actually need to use. So that's a way of obtaining some capital, some working capital to start your business. Another way is the credit card method. And so this is a more expensive form of debt, but it is used by some people. There's a story, you've all heard the stories of somebody who uses their credit cards, maxes out all their credit cards, to start a business. And a credit card can be used for ongoing expenses in a company. That's typically what it's for. You fly around, you drive, you buy products, you buy services, you go to a restaurant for a business lunch, something like that. And so you use the credit card to purchase services and goods and for the use of your business. Now you're going to pay interest on that, higher interest than a line of credit because the risk is higher. You're going to utilize that credit card, hopefully, to purchase items that will be used in the, let's say, the next period, the next month, or the next quarter. And then, of course, the intention is to pay it off before the end of the quarter so that you don't create a balance and have some sort of outstanding amount, which then can compound and take you right up to your limit and then cause an additional pressure point on your. Another form of debt financing is a bank loan. And in this case, you might, for example, you might want to buy a piece of equipment. You might have, if you're roasting coffee, you'll buy a coffee roaster. You might have to buy a packaging machine. You might have to buy shelving. You might have to have a device that packages and labels products. And so a bank loan sometimes is obtained. Bank loans can be shorter term than a mortgage. Mortgage can be 25, 30 years. A bank loan can be 3, 5, 7 years, something like that. Usually 10 years or less. And the idea is that the bank will lend you the money on the strength of that piece of equipment. So they will force you to sign, documentation that allows them to seize the equipment if you default. And that's the collateral. That's how the bank decides to lend you money. They may even ask you to do a personal guarantee. This is something that a lot of business people complain about, is in addition to that collateral that you sign over to the bank, they also demand of you in the form of a personal guarantee. Not much fun, hardly able to resist that. There are other bodies out there in our societies that allow some not-for-profit organizations such as SBA, the Small Business Administration, or the Community Futures program, depending which country you're in. These programs are run with a focus of lending money under better conditions than banks do. They're not conventional banks. They might be called lenders of last resort, which sounds strange, but you get the point. The idea is that these organizations will lend you money, and they will focus particularly on startups, women-led businesses, indigenous-run businesses, or businesses that have particular circumstances such as are fulfilling maybe social need, like social enterprise, or that are focused on an area, a geographic area, for example, that needs revitalizing or it needs assistance, or where they're trying to attract a group of businesses to an area like an entertainment district or a sports entertainment district, something like that. These are examples of debt financing. You can go to angel investments where investors will place money, and that's now moving us into the category of equity financing. Equity is different from debt. In the debt financing method, you borrow people's money, you pay interest, you have to pay it back. And if your business fails, you then still owe the money. Whereas if somebody puts equity into your business, let's say you find an angel investor or a family member to help you put the working capital together to start your business, that's called equity financing because they then earn the right to have shares in your business. And so if you sell a certain dollar figure of shares in your company, let's say you sell 20% of the shares of your business, that person that puts in that equity capital gets some shares, and the shares have all kinds of rights and responsibilities and duties and things like that. But the point is, they then own a part of the company with you, and therefore they may be part of the decision-making process with you, or they may simply be passive observers, and it just all depends on the percentage back and forth of who owns what. But the point is, angel financing is a way of bringing in capital, working capital, to start your business, to get it going, to launch it, to start doing sales and business development, and maybe even to do product development in the first place. The point is, though, if that business fails, then everybody goes down together. All those who put their money in lose their money. You don't owe anybody any money. The challenge between the two then, debt and equity, is debt, you can keep control of your business, 100% of the shares, but you borrow people's money. You You have to pay interest, and then you could lose that. If you lose the business, you lose that, and you then have to still repay the money. Whereas if you are getting equity financing, you lose some control in the beginning because you share responsibility of ownership. You share ownership with somebody else. But if the company fails, you all fail together, and nobody owes anything to anybody. Now, on the other hand, great news for both. If the company succeeds, well, then the debt part is paid off, and the equity part, everybody's happy because they prosper and the shares grow in value. With respect to equity capital, is venture capital, and that's a more sophisticated form. It's a later stage of capital. You usually have founders' money first, and then friends and family, or as we call it, friends, family, and fools. Just joking. And then you will have angel financing, and then you'll have venture capital financing or private equity, all the way up to where a bank might decide to help you obtain some capital. Which is why then in some certain circumstances you start out with equity financing, but then you move towards bank line of credit or bank loans. And so there's a hybrid, there's a combination effect. When you do equity financing, there are some concepts that we won't talk about in detail today, but you'll have a deal room where you make available all sorts of financial information to investors, and you will do a pitch, which means you'll have a slide deck that puts forth the story in a 12 key question format, which we always foster. And then you'll have beneath that deck, you'll have 150 slides that do it in much more incredible detail. You'll have a series of financial forecasts. So when you look for equity capital, as well as on debt financing, you need to put an analysis together so that the lender or the equity financer looks it over and decides that there's the right circumstances are in place, you could say, for the capital to flow. Finally, there's a third type of money that comes in to do a startup. This is what we call non-dilutive capital. That means it does not affect the balance sheet. It's just money that you get. It's not exactly revenue, but it's you could say it's free government money in one sense. There's nothing free, and it's not government money. It's the taxpayers' money or government's borrowed money. But the point is, non-dilutive financing would be things like grants, small business loans, low interest loans, awards, funded trials of your business. You sometimes win a business challenge and you can win $100,000 or $50,000 or $250,000, that sort of thing. So non-dilutive money, most governments in Canada and the US in particular, and in Europe, have what they call non-dilutive grant agencies that look for ways to help small business. They provide grants or low interest financing or other forms of support. They might provide advice, they might provide what we call a credit facility so that you can buy some equipment, and temporarily they'll pay the like a bridge financing approach where they'll pay for the equipment or the supplies, and then later when you produce the product and sell the equipment, then you get your revenue, and then you pay off the credit facility. So there are many complicated mechanisms, but they're very interesting. So those are the three ways to finance a business. Here are some other, probably half a dozen of other considerations, which I will cover very quickly today because we don't have the full time that we could devote to this, but it's important to understand, first of all, the concept of dilution, which means that when you give up a percentage of your business to some other angel financer or a family member or somebody who buys shares in your business, you are diluted, so your percentage ownership starts to decrease, and the more rounds of capital that you bring in, well, the smaller perhaps your percentage of the company is. But the good news under dilution is that you hopefully are getting a smaller percentage of a larger pie, and a small percentage of a larger pie can be as attractive mathematically when you exit as owning a big piece of a small company. So there's the whole concept of dilution. There's the concept of pre and post money valuation. So you should learn that concept. We won't go over it today, but you could study this pre-money valuation, that is before the money comes in. What's the mathematical treatment of when money comes into the business from an equity financing arrangement? Hence the term post-money valuation. There's also the concept of valuation, which is what is the business worth at any given stage of it, at a startup, as the sales start to grow, as you get more traction, as you bring in more money. And so there are four main ways to evaluate a business. There's 3 to 5 times EBITDA, which is earnings before interest, taxes, depreciation, and amortization. That's a complicated formula, but we can explain it in detail. Contact me if you want to talk further about it. Number 2 is comparable values, just like houses. When you sell a business that's similar to yours, you can find out what the price was. Sometimes it's secret because it's private information, but usually you can discover the comparable price was. Number 3 is the future stream of forecasted revenues 3 to 5 years out, brought back to net present value. There's a complicated formula there. And then there's the fourth method of evaluating a business, which is the startup again. So in other words, to start completely from scratch, put in all the money and the time and the effort to get you to this point. That's another way to evaluate a business. And so you could have these four methods. You could bookend them high to low. You could average them. You could use them in a negotiation to help you when you're getting especially equity capital. Another concept to remember in financing your business is the change of control. If you borrow money and you do debt financing, nobody else actually controls your business. Nobody else owns your business, but you might, because you're signing agreements, and you are making covenants. That means you have to agree to run your business according to a certain standard. If your company fails, you certainly will lose control of it. On the other hand, if you have equity financing and you get people's money and they become shareholders with you, you lose a certain percentage of control. But as we said a moment ago, the company fails, then you have nobody owes anybody anything else. So there are lots of considerations in the area of control. Another area of consideration is what we call the USA, the Unanimous Shareholders Agreement. This is an agreement among the shareholders that talks about all sorts of circumstances, like how voting is done, how control changes, what happens if somebody wants to sell or buy more shares or sell their shares, what happens if somebody is incapacitated or dies or divorces or has some other calamity in their personal life. How is it treated inside the company? So remember to spend a lot of time and attention on the Unanimous Shareholders Agreement, and we have some samples we can show you. Another consideration is what we call the capitalization table, or the cap table. This is a listing of all the shareholders in the business, what kind of shares they own, with what rights and duties and responsibilities, what kind of privileges like warrants and special options that allow them to the right to purchase property, say in the future, shares in the business in the future at a lower price or at a certain strike price. There's a lot of different information in the cap table, and it tells you many things. I have a 2-page document I can send you on the implications of a cap table, what a cap table tells you, what information it does provide for you. Another consideration is the team. The number one contributor to valuation of a business is the team, the people. Why? Well, yes, the technology, yes, the market, yes, the business, yes, the revenue. Everything is important, of course. But the most important is the team, because when the tough times hit you, when the pandemic that you didn't expect comes around the corner, when a government shuts you down, when you face a shift in the marketplace or a dramatic change in demand for your product, it's the people and their ability to respond to the pressure, to pivot, to make the right move. That's the key consideration in valuation. So pay attention to your team, pay attention to who you bring in. Don't just reward people that are, related to you, or that you know, or that are friends, or that are with whom there is a comfortable relationship. You may have to search wide and far for a properly professionalized team with the right skill set. And then finally, another area of consideration is the actual pitch itself, the ability to put together a slide deck that understands the mind of the investor and lays out the case, the story. Why is it compelling that somebody should invest in you? Why is it compelling that the bank should lend you money? And so in the case of capital acquisition strategy then, which we've covered in this short, it's the idea of the capital acquisition strategy has many considerations. Notice that when we go back to the very beginning, we had the two categories. The bootstrap method we disposed of very quickly because that's rare, and if it should happen, it's really almost a simple open and shut case. It's a simple story. The second case, the startup or expansion capital using debt, equity, or non-dilutive financing, or a combination of all three of those, that's tricky, that's challenging, that's tough, and it has all these considerations we talked about today. So it's important that you understand that when you accept somebody else's money, whether a bank's loan or any kind of debt, or equity financing from any kind of an angel investor or a family member or a friend or a venture capital group, you are on a path to exit that you can't control 100%. This is the thing to remember. I'm not painting this as a negative. I'm just saying that if you accept somebody else's money, even the bank's loan or the line of credit or a simple credit card, you're subject to somebody else's rules. And that's the reality of working capital or capital acquisition strategies. You must take into account not only the mathematics and the impact on your business, your ability to repay or your ability to share decision making, etc. It's that the moment you take somebody else's money, even in the form of a debt instrument or a credit card, you are influenced by that group or that person in a way that takes you off your course. So you no longer have complete control. You share responsibility. Many business people, most business people, accept this and they're willing to live with the ambiguity that suggests. But it's tricky and it's not always easy. So I want to make sure that you understand that someone else inevitably is going to be looking over your shoulder at the very least, or joining you in your decision making. And that means you're going to share responsibility, and that's something sometimes the entrepreneur finds difficult to handle. So there you go. We talked a lot about capital acquisition strategies today. There's so much more we could cover. Stay tuned. We'll continue with this series, and I hope to be able to provide you more information on capital in upcoming sessions. So God bless you. May you have every success in business. It's the Catholic CEO, Henry Kutarna. Thanks very much. See you next